Good morning, everyone. Welcome to this update for global stocks and commodities for the 2nd of June. As you know, I've been saying for probably a year or more that global growth, whilst it was modest, was good enough to sustain the US stock market at the levels that it was at. And perhaps the indices, if things went well, if earnings came through nicely, then perhaps the S&P could even advance to new all-time highs. So that's what I've been saying and what I believed for the last 12 months. But many things are now changing fairly quickly. And I must say that my confidence is being watered down just a degree. Now, this is not a change of heart at all, but it's just an early warning sign that that maybe things are changing for the negative. One thing that I have said consistently is you always need to be open-minded. There's nothing wrong with taking a particular stance based on facts. But if the facts start to change, then you've got to be open-minded enough to change your position. And I think we might be just approaching a point like that at the moment. Now, a lot of what has happened in the last week is really down to Trump. Perhaps it's been building for some time, but he certainly is making the markets extremely nervous at the moment. So what I want to, oh sorry, that's out of order. What I want to cover this in this edition is that to me the backdrop is changing. I think there's enough factual evidence now to suggest that. But is that sufficient to warrant a change in how we deal with the stock market? Is it too early to change tack? So that's really the essence of this week. Now, Portfolio Analyst last week, I did address how to play the big rebound if it sets up. And as of last week, it hadn't set up and still hasn't. But things are certainly not moving in the direction that I would necessarily like. So I think that what I covered in Portfolio Analyst last week becomes even more important. So let's have a quick look at what is changing. And there's lots and lots of things that are changing, but let me focus on the key ones. First of all, the US-China dispute is escalating. I don't think there's any question about that. And it's becoming quite clear now that this is far, far more than just a trade dispute. This really gets to the heart of the fact that America has economic and military leadership, and China wants it. China has been beaten up badly over the centuries. And this is an issue of national pride, I believe, and is a long-term theme. And I don't think either side is going to give ground on what their aspirations are. America to hang on to that leadership, or China to get it off them. So there's a lot more at stake here than just a trade dispute, and that's why I don't think we're going to see any sort of complete resolution of this anytime soon, and that's going to keep markets fairly nervous. And specifically, some of the things that are escalating, we've got individual company boycotts. America has effectively tried to cut off Huawei, which is one of the biggest telecommunications companies in the world. China's responding by threatening to withhold rare earths from the US, which is absolutely critical to so many areas of particularly American security as well as energy. So, that part of it is escalating fairly badly. The second thing, Trump bravado is certainly escalating. We've now got Trump using trade tariffs to try and get what he wants on just about everything. So he doesn't like immigration from Mexico, so he's threatening tariffs on Mexico. And the market took that fairly badly on Friday. There's also now threats from Trump that are really pointed at Germany, France, and the UK regarding them trying to find a way around the Iran sanctions. So, he's now starting to make nasty noises against his allies as well. So this is not a good scenario that's unfolding. The third main area is that bonds and commodity prices are now starting to point towards a recession. Now, whether they're right or not remains to be seen. Time will tell. But certainly what's happening in those markets certainly looks that way. And it's also being accompanied by some hard evidence now. which I'll get to on the next slide. So that is, in essence, what has really either changed or been building up and has now become clear in the last week or two. So if we go to American stocks, the S&P ended up losing 2.5% for the week. It still remains within that minor pullback territory, which is less than 10%. However, some of the fundamentals are deteriorating, certainly globally, and also in the US as well. So I'm talking about PMIs, Purchasing Manager Indexes around the world, are certainly softening. The trade flows, it's quite obvious from a chart I saw during the week that the trade flows are being impacted. And that, of course, if trade slows down, then global GDP has to slow down. And in the States, the headline jobs numbers are okay, but if you actually look behind the numbers at some of the components, there's actually some cause for concern about job creation in America. And look, there's lots of other things. I won't bore you with all the details, but certainly there is some hard evidence coming through now that things are changing. And finally, as we'll see on the charts, the S&P, there was some key technical levels were breached last week, and in the short term, that becomes a bit of a self-fulfilling spiral. Once the key technical levels are breached, then that brings in more selling, which causes lower levels. Now, turning to this, so we'll look at all that in just a sec. Now, turning to the US dollar, it was up for almost the whole week and then gave back all the gains on Friday to finish flat. But the real action was in 10-year Treasury yields, now down to 2.12. It was 3.25 less than 12 months ago, and now we're down to 2.12. It's just been a meteoric plunge in yields and rise in bonds. So money flowing into bonds pushes bond prices up, which pushes yields down. So the bond market is screaming recession. Now, again, whether that turns out to be valid or not is something that we'll find out. But certainly the bond market is screaming at us that there's a recession coming. And we also saw that whilst high quality bond prices were bid up, junk bonds, which is the lowest level of corporate bond issuance, were actually heavily sold. So that's not a great sign either. So let's jump in and take a look at some of the charts. And we'll start with the S&P. So big picture first. This is a monthly chart. This is 2009. So that's the bottom of the GFC. So just to put it all in perspective, so we've retraced about 1/3 of the plunge that we saw in the last quarter of last year. So we've had 4 months up, 1 month down. That's basically taken us back to around about where February finished. So it's certainly not a disaster by any stretch of the imagination. Let's zero in on the daily. You can see the red line here is the 200-day moving average. It has now flattened out. And the index has now finished just below the 200-day moving average. We also saw this low here from the 13th of May breached as well. So we've set a lower low, and we've also broken the 200-day moving average. So that's not particularly great. The next support level comes in here around 27.21. And you'll note that we are now oversold on the S&P, and quite heavily oversold. So a bounce sometime next week would not surprise at all. But look, it's incredibly news-driven or tweet-driven. So it's incredibly difficult to anticipate what's going to happen over very short time periods. So that's the S&P. Let's just check in on the NASDAQ. So this is the QQQ, which is the ETF reflecting the NASDAQ. And you can see it's also returned. It's just sitting on the 200-day moving average at the moment. And there's no, there was a bit of additional selling off the top here, but it's not disaster territory in terms of volumes at this stage. And if we look at the Russell, the small caps are definitely weaker. You can see the red 200-day moving average line has well and truly rolled over. That happened back in November. and we're now back trading below that level again. So it's not definitive. We're oversold. Bounce wouldn't surprise, but it's certainly not looking nearly as healthy as it did 3 or 4 months ago. Now, a couple of other charts that I want to show you that are important. So this is the 10-year yield. So here we were in October, trading at 3.25, and just look at how sharply that has plunged down to almost 2.1. And if we take a bigger slice, you can see that we hit levels. So the bottom was basically in July of 2012. So this is a weekly chart. So July 2012, we hit 1.4, and then we hit that level again in July of 2016. So you got to wonder whether we might get down closer to that by July of this year. So that's the 10-year yield, and that price action is just screaming at us that there's a recession. Now, if we looked at the high quality end of the bond market, treasury bonds, you can see that treasury bonds have been bid up. So they were down at a low of 113, 112. We're now trading at 132. So that's been a very substantial rise. And if we look at the junk bonds, so this is HYG, you can see that periodically when the market gets really nervous, we get these very sharp sell-offs. So there was a sharp sell-off here in 2015-16, which led to a fairly substantial share market downturn. We then had another little sell-off at the start of 2018, which again accompanied a pullback in the market. And then we got a sharp spike down in December of last year when things looked really nervous, when it looked like interest rates were going to be going up substantially. And then it bounced back. And you can see now, up until Friday, the junk bond, high yield end of the corporate bond market was holding up pretty well. But that was a decisive move on Friday. So clearly there is now some selling. We've got elevated volume. So the high yield junk bond market is also sending us some distress signals as well. So, you know, that's what's changed quite a bit. Let's look at the US dollar. So we gained throughout the week and then lost it all on Friday, but you can see we're still in quite a decent uptrend. Just while I'm here, I'll just look at the Australian dollar. So we got a bit of a bounce on Friday in the Australian dollar, but clearly we've broken this support at 70. And if we get 2 or even 3 more rate cuts, then I think you're going to see the Australian dollar going down further. And there is certainly some talk now that the RBA, rather than cutting by 0.25% this month, may in fact go straight to a 0.5% cut. That is a possibility, perhaps a more minor possibility at this stage, but nevertheless it is there. Now I just want to look at what the consequence might be for the US stock market if things do deteriorate further and we start to head further towards a recession. Now this is a chart going back to 1995 that shows the forward operating PE for the S&P, and you can see that the long-term median is around about 15.5. So in other words, the index is 15.5 times the earnings capacity of the S&P 500. Now this chart is currently showing that we're at 16.9, and so the point that I raise is that, actually I'll come back to that. I think I've got a slide on that point. I will come back to that because I've got a few other things that I want to cover. So moving to the Aussie market, the Australian dollar finished steady at 0.693. So it dipped lower than that during the week, but managed to recover. Iron ore is helping that. If iron ore wasn't above $100 a tonne, then the Australian dollar wouldn't be where it is. But the path of least resistance is still down. It looks incredibly likely that the RBA will cut rates probably this month and at least once or maybe twice more this year. So I think that's where the Australian dollar is heading. The ASX 200 was down by 60 points on the week, and that I think that's going to obviously move to a significantly lower level on Monday, because it's we're going to get that flow through from the American market. I find it hard to see it holding this level, to be honest, when you consider what constitutes nearly 50% of the index. It's the miners, and we've got commodity price pressure. It's the banks, and I don't see necessarily a positive environment for the banks. Yes, we had a bounce because of the election result and because of the reversal of the franking credits thing, but when you get past that, it's still a fairly sombre outlook and environment for the banks. So it's hard to see staying at that particular level. Okay, let's just take a quick look at the ASX 200. So you can see it's been a very, very nice rebound since December last year, when we were trading down around 5,400 points, and we've now managed to get back to 6,400 points. So we've stacked on 1,000 points. But yeah, I'd be very surprised if this doesn't track back down towards the 6,000 level over the remainder of this year. Now, just coming back to the US situation. So the earnings, the level that the US market finds itself at is always a function of earnings and interest rates. And if the market is going to, and it's been sitting up at this level because earnings were bowling along quite nicely and interest rates were at the level that they were at. We're now getting perhaps a change in circumstances, and that begs the question, will the market re-rate down as a consequence of that? So if we come back to this slide, so if we do get a derating of the market back to, let's say, the median level, then that's about between 8 and 10% lower than where we are now. So if the market were to derate to this longer term level, then that represents around about another 200, 250 points off the S&P. So that takes us down to somewhere between 2,500 and 2,600. So let's just put that in perspective. So if that were to be the case, then we would be looking at a range somewhere down here. Now, that, I'm not saying that is what's going to happen, but that is if the market decided to derate back down to that level. But we've always got to remember that the central banks are just not going to sit around twiddling their thumbs. They're going to get stuck in and do stuff as well. So then that is going to offset any reduction in global growth or slowing in earnings growth. So this is a very, very fluid situation, that's for sure. All right, let's move on. Precious metals, gold certainly spiked up $20 to 1306. And it was interesting that gold hadn't spiked up because of the US-China dispute, but when Trump decided he'd take on Mexico as well, then that really caused gold to spike up, because it does put the North American Free Trade Agreement at risk, and that's important for all the parties. So we got a big spike in gold, and also the Australian dollar gold price went up as well to 1885. So we're almost bordering on 1900. So the local gold miners should enjoy that next week as well. Now GDX finally responded. It hasn't really done much in recent times, but we got a good response on Friday. Local stocks had a strong week last week, and I think there's certainly more to come. So let's take a look at that gold market. So that's gold on a weekly chart. So you can see we're still just hugging this uptrend line. Need to get above 1380 to be a definitive change in trend for gold, but it's still heading in the right direction. And that's Thursday and Friday on a daily chart. Now, if we swing over to GDX, you can see quite a good week, the best week we've had since January. So GDX also needing to get above around about $25 would be certainly much more encouraging, but it was certainly a much better week for gold and for gold stocks, and they do provide a partial hedge to not only currency but also to falls in the stock market as well. So it fulfills a multiple purpose. Turning to other commodities, copper was down again, down to 262, so that's screaming recession. Crude oil also has fallen very, very sharply. It's dropped $10 in 2 weeks. And this is just a sector to avoid until we get a confirmed turn. It was looking so good just a month or 6 weeks ago, and it's just absolutely fallen off a cliff. There's the spot copper chart. You can see it has also fallen from around $2.95. We're now down to the low 260s. And there's the crude oil chart. You can see just how sharply that has fallen from 66.5 down to 53.5. So there's been just a massive, massive change in commodities. And the only reason that iron ore is doing as well as it is because of the situation in South America with tailings dams that has curtailed around about 100 million tonnes of seaborne iron ore trade per year. So otherwise the iron ore price would be down, and I think the Australian dollar would be lower as well. So to wrap it all up, this is a very tricky market to negotiate. Sentiment has certainly soured. It's no question we've had a plunge in bullish sentiment. We've had a spike in bearish sentiment to extreme levels. And certainly we're now seeing economic data softening. Where to from here? It really rests heavily on whether there is further trade escalation or not. And that is just such an unpredictable thing because, we're dealing with Trump. The Chinese are going to be measured in their response, but Trump is completely unpredictable. And so therefore, knowing whether we're going to get a trade escalation or some sort of about turn because Trump wants to protect the stock market is just anybody's guess. So a very tricky market. The other thing that we don't know then also is the extent of the central bank response, as I said earlier. Central bank has got a lot of things that they can do, a lot of levers they can pull, not so much in Europe where things aren't looking all that clever at all, but certainly the US Fed certainly has a lot of things that it could do. So from my perspective, it's a matter of focusing on where the risks are minimal and the upside looks highly likely. In America, I think there are quality stocks can only be sold off so far. They'll get down to a point where money will step in and buy them. So that's where the risks are minimal and the upside looks highly likely. In Australia, my focus for a couple of years now has been on stocks that are independent of macro events and independent of the Australian economy. So that continues to be, I think, a fairly productive area. Portfolio Analyst this week, I'm going to be focusing on what we can control ourselves because there are some things that are out of our control, and there's no point in stressing about them. Just focus on what it is that we can control. People and markets always extrapolate negative indicators too far. That's why markets always sell off much further than they should, and then they bounce back. There is a very good chance that things will not end up as badly as some projections are that are out there at the moment. As always, it comes back to what's fair value for stocks, and given the growth and the interest rates. What's exercising my mind at the moment is whether markets will reset and hold at a lower level, on a semi-permanent basis. In other words, is the US market going to go down to 2,600 and now stay there in that area for some time, or will things just get back to normal? Trump can't afford to have a weak stock market. That's one thing in investors' favour. He's got an election coming up next year, and if the stock market is weak, that will not help him one little bit. So there will reach a point where he is going to have to try and reach some sort of accommodation that the stock market likes. So at least we've got that in our favour. And we've also clearly got the US Federal Reserve that has shown that they're basically going to respond to what the market wants and doesn't want. So there's a couple of things that are in our favour. So that's it for this week. Fairly long-winded, but important. And for any non-members, there's my contact details if you would like to contact me. And of course, Portfolio Analyst is available on a $1 trial basis for anyone that hasn't tried it. So that's it for this week. Cheers.